Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week I am speaking with Ben Whitmore about his new value equity fund boutique, Brickwood Asset Management. Ben is one of the UK's most renowned value investors. Before he launched Brickwood, he was a star at Jupiter Asset Management, where he handled around a fifth of Jupiter's assets. In fact, news of his exit sent the shares down nearly 15% in a single day in January. So, needless to say, Ben's investment strategy is really worth paying attention to. And in our conversation, we talk about the funds he's launched, why he launched them in the first place, and what he expects to happen next. Ben, thank you so much for coming in today. We hugely appreciate it. It's nice to have you with us.
Thank you very much indeed for having me.
Right, now we have to start with why you've done this in the first place. Why would you leave a giant, comfortable company where you're earning billions and billions of pounds, presumably making an excellent living, everything going very well, great reputation? Why would you leave all that to set up on your own?
No, look, I think it's a great question. It's not just me. There are four of us. And we just felt that there was an opportunity to create a value boutique, really well known for value investing, and that we, by concentrating on that, we could design the systems and technology we wanted, we could have the client service that we wanted, and that by really focusing on it, we hoped that in the end that would lead to better outcomes for the clients by that sort of real focus of the whole organization. And we felt that there was an opportunity to do it. Value had been pretty scarred over the last 10 plus years, especially globally. And we felt that there was an opportunity that might occur over the next 5-10 years for some form of mean reversion. And we felt that there hadn't really been any value boutiques out there recently launched. And we thought that was just an opportunity. We all liked and trusted each other and felt that the team of us, we could give it a shot. It's
interesting though, isn't it? You're right. There are very, very few real value players left out there after all these years of value not working. There aren't very many value boutiques, and there weren't really that many value teams sitting inside any of the bigger companies.
Yeah, absolutely. And I think that's just a natural process. If you've started in fund management in the last 5, 10, 15 years, value investing has not been a growing area. It's been shrinking, or people have retired or given up, and so naturally you've gone into the other areas that have been increasing their headcount.
Let's just go back even one more step and say we're going to talk a lot about value investing, but what does that mean to you? When you say value, what are you talking about?
Yeah, I think it's a very good question, because at one extreme, some people think it's Ben Graham buying heavily discounted companies trading at below the cash on the balance sheet. And at the other end of the spectrum, it's Ben Graham's most famous student, Warren Buffett, who's more about buying, very good quality companies at reasonable prices, I think. And for us, the key thing is that the starting point is the valuation. So we are looking for low valuation. But just as importantly, just as if you're in a supermarket doing your weekly shop, value is a trade-off between price and quality. So we're very keenly aware that starting valuation is extremely important, but you need to be cognizant of the quality of the company. One of the great things about value investing is there's a lot of books on it. You can read and read and read. And one of the sort of key guiding points for our investment process is the cyclically adjusted price-earnings ratio. And now what is that? That is, rather than take a snapshot of the earnings, because you don't know where you are in a company's life cycle or economic cycle, Graham and Todd suggested you take an average over a business cycle, and they said 7's better than 5, 10's better than 7, so 10 as an approximation of business cycle. And if you like, we're looking at companies that look lowly valued on their average earnings power over a 10-year cycle. And that way you get much more of a feel for where true low valuation lies, rather than, if you like, accidentally picking a cyclical company at its highs or conversely avoiding it when it's at its lows. And that for us is one of our absolute key valuation metrics. And the other reason why we believe in it so much is we're very evidence-based, and the evidence over long periods of time shows that that's a very powerful indicator of subsequent returns. And if you look on sort of online resources for this, Professor Schiller has a whole series of this stuff around the Schiller PE, which is the same thing, the cyclically adjusted PE.
It's lousy for timing, isn't it?
Very poor for timing.
Yeah.
But it does point you like a
point you in the right direction.
Good map in the right direction.
Yeah. And that has a tendency to revert to the mean.
Yes.
And again, one of the conversations that I've had with a lot of growth managers over the last decade or so is the idea that reversion to the mean is dead because the very fast-growing technology companies destroy the idea that any sector or market as a whole would revert to any kind of mean.
Yeah, and they're absolutely right to a degree. But what I think is also very important to bear in mind is that innovation, industrialization, technological change has been happening for the last 100 plus years. And so it's not a new phenomena. It's been happening for the last 100 years. So we don't need to talk about all the things that have occurred in the last 100 years, which have surprised and shocked people. But that rate of innovation and change and new products, new ways of housing formation or shopping or transport or ways of living have been in place for the last 100 plus years. And the evidence stretches back over nearly 150 years. So I absolutely acknowledge that. But I think where I differ would be that's been in place for the last 130 years. Imagine going back to, I don't know, the data tends to start in 1871. But if you went back then and imagined what life was like in 1910 or 1930 or 1950, 1970, you would think that there's been the most incredible amount of change. Now, I do think it's right that it's probably more exacerbated now, perhaps, than it, say, would have been in maybe a decade of the 80s. But that change is always something that's been around in the world economy. And so I don't think that this particular period means that everything that has worked in investing is now discounted.
You have launched value funds really at rather a good time. Right? Your timing, whether purposeful or not, has been fairly impeccable. We're just seeing the US market coming off. We're seeing significant falls in the Nasdaq this year, etc. And we're seeing the much cheaper European markets begin to pick up. So there is, or it looks like there is a beginning of a great rotation out of expensive US markets into cheaper global markets. Timing's impeccable.
I guess it's a bit hackneyed to say time will tell. But I think what you can say, leaving aside the sort of very short term, is that rest of the world versus America, or small versus large, or value versus growth, there are quite big extremes when you look globally. So when, if you like, the rubber band is pulled so tight, it doesn't take much to change that narrative. Now, I don't know whether it's going to be caused by everything that's going on at the moment, but we do very much believe that at some point there will be some, if you like, mean reversion or change in the very low valuation applied to quite a few assets in UK, Europe, Japan, Latin America, yes.
Well, why don't we start by looking at the UK, because that's the first fund you launched, the UK Value Fund. You just mentioned that there is this big gap between large and small. Smaller companies have massively underperformed, and if you're really looking for extreme value in the UK, you might go small, but you haven't done that, right? It's a large cap fund. Yes,
it's a large and medium-sized company fund. I co-manage that fund with my colleague Kevin Murphy. That's where we've spent our last combined 50 years
And
of
Kevin
experience.
Murphy came from the value team at Schroders.
Yes, exactly. And that's where we spent our 50 years concentrating. So we don't want to do anything different from what we have been doing. But yes, you can find a lot of very lowly valued shares in that whole space.
And the UK has been phenomenally unpopular for a long time, and we've talked a lot on this podcast over the last couple of years about the UK. It's so cheap, get in while you still can. If you don't buy these, other people will, etc., etc. And of course, everyone has completely ignored us, and we've seen ongoing outflows from the UK market over and over and over. It's been very, very depressing. So, you're really very optimistic here.
I think it just depends on your time frame. As you say, the outflows have carried on, but I think, flows tend to follow performance. And if you did see the UK stock market showing some good performance, I think you would see the flows change. But
and we are seeing some good performance in the UK. And even small caps aren't performing at the moment quite as badly as you might expect, given global upset.
Yeah. I am optimistic because the starting valuation is so low. I definitely can't predict anything around flows or timing, but I am very optimistic because just the starting valuation is so low. And history shows that very low starting valuations are good. Now, your point, which you make, is very valued, but what about the timing of it? And that I can't help on or can't predict. But what I do know is that very low starting point is a good sign for, if you like, the medium to long-term investor.
Okay. But I was reading the fact sheet for this UK fund earlier. One of the things you say is that your hope is to outperform the index on a rolling 5-year basis after fees. I hope you won't mind me saying that. That's remarkably unambitious.
Well, I think it's better to not try and set a very, very high hurdle. If you look back historically at the long-run data in, say, the IA UK all-company sector, historically, if you have had compounded at 2% per annum net of fees ahead of the index over 10, 15 years, you're comfortably in the top decile.
So why not say that you would like to achieve 2%?
Well, I think
more than the index over a rolling 5-year period net of fees.
As soon as you start getting very precise, it might not be that helpful. But I also think that you don't want to try and make very big promises either. I think you're much better to get on and run the fund and try and deliver that good performance here.
Okay, and we can see your history of good performance. So while you might not be promising it, we can make a guess at what you might be hoping for.
And I think also that financial services more broadly sometimes gets, bad reputation for sort of being a bit too aggressive on the marketing and such like. And I think you're much better to be cautious on promises and concentrate much more on actual delivery of it.
Fair enough. We spend a lot of time criticising fund management companies for being more marketing companies and money management companies and asset gatherers rather than activist investors. So fair enough. Okay, let's talk about the fund then. 46 holdings, so not that concentrated.
No, not that concentrated. There's a lot of academic and experienced evidence around how much you need for diversification. But also there's a sort of balance here. Probably 20 to 30 would get you sufficient diversification on a sort of theoretical basis. But there are also quite a lot of lowly valued stocks at the moment. So if you increase the number of holdings whilst at the same time being able to keep the valuation the same, you're getting a bit more diversification. So I do think that is sensible. I really do.
Okay. Well, should we talk about some of the stocks in that UK portfolio? Because I think we do have quite a lot of listeners who do buy individual stocks and are interested in these big, cheap, high-yielding stocks in the UK. And I'm interested to see, I am looking at your fact sheet, maybe slightly out of date. The dividend yield on it is 4.7%. And just for the sake of interest, the PE ratio, forward PE ratio average across the portfolio is 8.8 times. So remarkably cheap, actually.
It is a lowly valued fund. Just to highlight a couple of companies, two very different companies. We've got an investment in Travis Perkins, that's building merchant operating predominantly in the UK. It's actually trading below tangible book value. Its book value is predominantly some property and working capital. So when companies trade below tangible book value, the stock market's saying something very pessimistic.
Yeah.
They've got a new chair, and they did have a new CEO who sadly due to ill health has recently had to step down, but they've got pretty strong market positions. The business hasn't been that well run, hence the opportunity to buy it at below tangible book value. Difficult macroeconomic environment. But I think if we can find a whole series of investments trading at that low valuation with established franchises, but where there have been some problems, but not, if you like, permanent problems, that's exactly what we're trying to do.
Doesn't look like you're looking for particular catalysts. So there could be some value traps in here.
Yeah, well, I think catalysts by their nature are surprises. I think it would be quite difficult to say that we know what the surprises are going to be. Surprises to markets are genuine surprises. I think, though, what the evidence shows is that what we're trying to do is that low valuation helps to protect you from negative surprises. But at the same time, you're much more exposed to positive surprises. And so we don't know the catalyst, but what we think is that more broadly, catalysts tend to be either fears recede or profits recover. And somewhere in that area, is how we think we'll get the valuation change to reflect the value of the business.
Sorry, I interrupted you. You were telling us a stock story. Carry on.
I think, well,
Sorry.
The other one at the other sort of extreme in terms of business, but not in terms of valuation, would be Burberry.
Uh-huh.
That is a reasonably well-known luxury goods company concentrating on outerwear, scarves, and other fashion wear. That's had a very difficult time, partly due to a downturn in luxury spending in China, but also due to some self-inflicted wounds. They changed the chief executive last summer as well, and their merchandising and pricing strategy went wrong. The new chief executive is returning the business to, if you like, the real core check, if you like, which is what it stands for. And you're able to pick that up invest in that on a, if you like, a CAPE yield of about 15-16%, which is very low in relation to absolute valuations, whereby the stock market is feeling very pessimistic about the ability to recover the lost profits which have happened. And so if we can find, as you say, 40 to 50 ideas like that, we're very, very happy.
Have you been watching the TikToks of luxury goods being made in China?
No, I haven't.
It's worth it.
Okay.
It's worth it. If you go and look on TikTok, you're probably not on TikTok, because I'm not on TikTok either. I rely on my kids for this. But there are lots of videos doing the rounds of luxury goods factories in China, showing how things are made and when they're made in China, when you think they're not made in China, etc. They're fascinating. And I wonder if that kind of thing will have an impact on luxury goods spending.
So these are copies, is that right?
No. Well, supposedly not. I'm watching TikTok here.
Yeah, okay. So one of the things that Burberry has spent a lot of time on is the supply chain. So obviously it's very well known for its UK heritage, the manufacturing in the UK. So I think, clearly that is a concern for companies more broadly, but I'd feel pretty confident that wouldn't apply to Burberry.
Okay. Is there an ESG overlay of any kind on the fund? I see, and we'll come to the global one in a minute, but I see you have got a head of stewardship. It's kind of compulsory these days, right?
Yeah.
How do you approach all that? I mean, obviously it's not classic ESG, because in your top 10 you've got British American Tobacco, etc., Shell, BP. Yeah. So it's not your standard ESG overlay, but how do you approach that?
Yeah, so Andrew Mortimer is our head of stewardship, and the ES and the G are very important because they can be fundamental to permanent loss of capital if you don't take them seriously enough. Now, historically, people have always thought about the G, the governance. You've had poor governance that can lead to permanent loss of capital via poor management of the business, poor capital allocation. But the E and the S, the environmental and, if you like, the social side, those are important when you're thinking about, if you like, the sustainability of the franchise. And so for us, they're all part of thinking about investment risk. What is the risk that we're going to lose our clients' capital in any one investment? So yes, we do absolutely want to take all of those into consideration when making an investment decision.
Okay. Can we talk about BP a bit? That's been in the news a lot, and I'm sure a lot of our listeners are interested in it as a standalone stock. Yes.
So BP has been in the news, well, I guess a lot recently, but when I think about, since I started in the city in 1994, it's been in the news a lot. And you're absolutely right. It's currently in the news because the previous CEO tried to deploy more capital into low carbon or renewable assets. The returns on those have not been very good. He was also looking to shrink the oil and gas portfolio quite aggressively as the world transitioned away from, if you like, carbon assets.
Except that it's not really doing that, is it?
But the pace of change is not as fast as was anticipated. And so the new CEO, who was the finance director, is really running the company, I think, more in line with how society is changing. Now, that might come into for some criticism that they're not going faster, but I think he's basically adopting a more pragmatic approach. What really needs to happen, I think, at BP, and it's what they've said, is that oil and gas companies are very capital intensive. They need to concentrate on the returns from deploying that capital rather than, if you like, talking about the strategy, talking about deploying things and what the returns may or may not be. They need to concentrate on what the new change of strategy is around, is the actual returns from the capital deployed, rather than having a strategy what it might be.
Do you think that is happening now? I mean, this has been one of the most, of the many disappointing stocks in the UK that BP has consistently disappointed its shareholders, hasn't it?
You can see it in the stock market as expressed by the valuation. There's a sense of deep distrust in the company. And so I think you get a very low starting valuation, a sort of a very big discount to European and American super majors. Clearly, it's not a super major, really. It's shrunk quite a lot over the last 10, 20 years, especially following Macondo. So I think that big discount can really only be closed by them demonstrating operational performance. And I think that is definitely what it seems that the stock market and investors want.
Let's talk about the second fund, because you've moved pretty quickly here, launched UK one, it's still pretty small, and you've gone straight in to launch a global value fund, also still pretty small at the moment. What was the thinking behind that? Because you can have your UK fund, you can have 20% of the assets in non-UK companies, right?
Yes, you can, yeah.
Yeah. So you can put a little global in there if you feel like it, but nonetheless, you've still launched a devoted global fund.
Yep. So I'm managing that with my co-manager, Dermot Murphy, who I've spent the last 10 years working with, and we ran global funds together.
Are those brothers going to get along okay, do you think?
Yes, I do. Yes.
I couldn't work with one of my siblings.
Yeah. So I've worked with them both throughout my career.
But separately?
Separately.
Never together?
No, never together. But from all I can see is they get on very, very well together. There's a big age gap between them, which may well help. But they're both very passionate value investors. The three of us are sort of joined by that, if you like, by that great passion and interest. But why did we do a global fund? I think they're very different. And so here, this is about accessing opportunities all across the globe. And I think it's important to keep them pretty distinct.
There are some cross-shareholdings, right?
Yes.
BAT being...
Yep. There are some, so BAT or BP, there are definitely some cross-shareholdings, but we've got, exposure across Europe, Japan, Hong Kong, Latin America. There's a huge range of low valuation stocks to try and capture. And yes, they're very distinct portfolios.
Yeah. You've got the resource to cover the whole world like that. Yeah. You're in Japan, Latin America, so Europe, etc.
You're absolutely right. If you said, go and find these companies, but if you didn't have a process, I completely agree with you. But we've got a very distinct process. So we have two screens. One is, if you like, the cyclically adjusted PE, which we talked about. The second one is a Greenblatt screen named after Joel Greenblatt, famous American investor. So we run those screens and we use the screens. They're not magic formulas, but they're very good at pointing you in the right direction. We use these screens to push our work into a very narrow field. When you think about global markets, and so let's say maybe 10,000 investable securities. Yeah. And it pushes you into those areas and concentrate your looking and your modelling on those areas.
So you can use technology to make sure the universal stocks you choose from is actually very small.
So not only can you use technology to help you look for where the stocks are, but, and this has really been led by Kevin, you can also use technology to help you with all your modelling. So we like to model balance sheet, cash flow, profit and loss account, looking backwards for all the companies. You can use technology now to do that for you rather than thumbing through the report accounts and manually inputting the numbers. You can then integrate all of that with your order management system in an integrated data platform. So you can do an enormous amount of work to present the ideas in the format with the financial history that you want, so that you can spend much more time on considering the reasons why the share is lowly valued, thinking about the issues and forming an investment rationale.
And do you visit them down the companies?
We meet a lot of companies, but it's not a prerequisite. Some of our Japanese holdings we haven't met, but we tend to meet most of them, yes.
Tell us about your favourite Japanese holding.
So I'm not very good on favourite holdings. I think it's rather like the children.
I think everyone has all fund managers say that, but I bet you have favourite stocks.
No, I think
everyone has favourite stocks.
I think it's like children. You don't have a favourite child, but the amazing thing in Japan is how you can buy good businesses with good franchises trading below the cash on their balance sheet, the cash and investments. And so we've got a range there, whether it's, if you've got any listeners who speak Japanese, they might be horrified by my pronunciation, but I'll try my best. Whether that's Keito Sangyo, a food distributor, whether it's TS Tech that makes car seats, whether that's Medipal that distributes pharmaceuticals. These are all very lowly valued businesses, but where there are strong businesses underlying them. It's just that for whatever reason it is, the history of the Japanese stock market, they're trading at exceptionally low valuations.
That just goes on and on and on, doesn't it? And every time you think the Japanese market has come back, like you might have said, for example, last year before, then suddenly something goes wrong and the Japanese market is always hit harder than any other market. It's an incredibly frustrating market to be in.
I think there have been some quite concrete changes happen in corporate governance in Japan. And the evidence shows that when you look at things like share buybacks, dividend increases, that whilst there still is issues around corporate governance and independence of directors, there is actual tangible change taking place. Yeah,
I agree. Well, we talk about that a lot on this podcast as well. We're big on Japan as well, and often slightly disappointed. Are there any other really interesting stocks in that global portfolio that we could talk about? We would like to talk about, not a favourite, just the most interesting.
There's a huge spread, whether you're talking about, say, a Latin American brewer, net cash on the balance sheet, very low valuation, whether you're talking about European satellite company on a 10% cash dividend yield, where there's now a view that maybe European governments don't want to rely on Starlink. There are lots of interesting things which are very lowly valued. The other small area of the portfolio which is very lowly valued is anything to do with dentistry.
This is a first. No one has ever mentioned dentistry on this podcast before.
So dentistry is probably, we all know it, is very stable. So your annual checkup is very, very stable. But what is cyclical is the sort of high-end teeth work, which has become Invisaligns
and that kind of thing.
Yeah, well, just more sort of complete makeovers of your teeth. It's proven to be a bit cyclical. And at the same time, the companies that supply implants or aligners also supply the equipment for the screening and diagnostic tools for the dentists. And if the dentists have got less high-end work, then they're less inclined to replace the screening tools or the diagnostic tools. So there is a bit more. The market was surprised by the cyclicality that when interest rates went up. And so what that has is that we've got two investments in dentistry. One is called Envista.
That's the American one.
And one is called, its ticker is X-Ray, but it's a dentist supply, Sirona. And both of those are very, very lowly valued because people have seen what's happened in the last few years and have become very, very concerned about the dental, both equipment and implant market. But we think over like the medium term, dentistry is quite a concentrated market in terms of companies operating in there. Will revert back to mean people will save up and do more of that high-end work in time.
Yeah.
But the valuations you can buy them at are very low. And these are reasonably strong businesses. There's quite a lot of IP and technology in dentistry.
Okay. One of the things that we talk about a lot on the pod, and that has obviously been the massive outperformer of the year and actually of the decade, is gold. Any exposure to gold in the portfolios? Would you ever hold a gold miner?
So we're long only equities. Mm-hmm. So we can't use any of the normal things that protect from downturns in markets like derivatives. We don't use any of that. We're just long only equities. But we do think about insurance. And by that, I mean shares that would do something different if the markets fell. We do have a holding in a gold miner. We also have a holding in a company called Flow Traders that benefits from sharp rises in volatility, which tend to occur with like deep drawdowns in stock markets. So we do tend to think about insurance as well.
Okay, interesting. That's how we always look at gold, as being portfolio insurance. You really hope it doesn't go up, but when it does, you're glad you had it.
Yep. So we do definitely think about that, yes.
So presumably that means you hold some exposure to Bitcoin in a portfolio as well.
So we don't have any exposure to Bitcoin, no. But when I did read the last statement from Flow Traders, they make markets in ETFs, and there are quite a lot of crypto ETFs. So, I mean, there is like a secondary, thirdary order, but that would be quite small.
Interesting. Thank you. Brilliant. Thank you very much for joining us.
Thank you very much.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound design by Blake Maples, and special thanks, of course, to Ben Whitmore.